One expert says there's a 67% chance the S&P falls 20% by October.
Another says the labor market is already breaking and the real shock plays out into 2026.
We run every thesis where they overlap and the one data point that will prove them right in 5 minutes. George Gammon, the market commentator who flagged the Dow-Nasdaq divergence, says this indicator implies a very high crash probability.
Right. He points to a 5.5% gap over 7 to 10 days and cites a historical 67% chance of a 20% S&P drop within 3 months.
So, he's basically saying, act now, like portfolio protection levels now, not later?
Exactly. His trade idea is pairs trading to hedge sector rot and capture that relative breakdown.
Melody Wright, who surveyed over 1,000 build sites, has a different frontline read. Housing supply is far larger than official data shows.
She points to shadow inventory, failed short-term rentals, builder backlogs, and units held off market, and warns the real correction hits in 2026 when debt maturities arrive.
Wait, so the housing crash she describes is driven by invisible houses suddenly becoming visible?
Yes. Her signal is active listings and price cuts, not lagging median sale prices.
Jeff Snider, the payroll analyst, says the headlines lie. The household survey plunged, showing a very real labor market breakdown.
He highlights a 507,000 drop in household employment, big downward revisions, and an unofficial unemployment near 6.1% once you add dropouts back in.
So while job headlines whisper resilient, he's shouting the bottom is falling out.
That's right. His call is to watch participation and full-time employment as the leading danger signals.
And Jeff Gundlach, CEO of DoubleLine, brings the debt math. Interest costs are around $1.1 trillion, and that creates a vicious feedback loop.
He flags the SOM rule and the S&P 4,600 level as a potential double top, and he prefers treasuries over junk into a downturn.
So Gundlach's playbook is defensive, safety in high-quality bonds, while the debt servicing problem unfolds.
Exactly. He sees the monetary and fiscal math producing a recession late this year or early next year, unless something breaks the loop.
Here's the common ground. George, Melody, Jeff Snider, and Jeff Gundlach all warn downside risk has meaningfully increased.
Different routes, AI unwind, housing inventory, collapsing labor, or debt servicing stress, but they all conclude the system is more fragile than headlines imply.
So whether it's tech, houses, jobs, or bonds, the theme is the same. Downside risk is elevated.
Yes, that shared warning changes how you size risk and where you hide value. Another place they overlap. Don't trust the big headline numbers alone.
George looks at short-term price divergences between indices. Melody tracks active listings and price cuts. Snider watches household employment and participation. Gundlach watches the SOM rule and the yield curve.
So they're all saying, look at the fast real-time gauges, not the delayed press release data.
Exactly. That agreement tells you which dashboards to check when markets get noisy.
Big clash on timing. George says the divergence creates a 67% chance of a 20% S&P drop by October.
Melody and Jeff Snider disagree on immediacy. They both point to structural problems that peak in 2026. Housing inventory and the end of artificial boosts.
Hold on. So George is shouting 3 months, and Melody and Snider are saying watch 2026?
Yep. Gundlach sits in the middle. He expects recession late this year or early next, and recommends treasuries, which is a timing and positioning split from the others.
So your read depends on whether you prioritize short-term market signals, on-the-ground housing flows, labor participation, or debt math. They also disagree on the root cause. George blames an AI circular financing unwind that deflates tech returns.
Melody says the trigger is housing. Once hidden inventory floods the market, price discovery forces big losses in real estate.
And Jeff Snider is like, no, watch the jobs data. The labor market collapse will rip through demand.
Gundlach, meanwhile, ties it to fiscal math. $1.1 trillion in interest and bond market buyers stepping back, which creates a feedback loop into yields and recession.
So it's not just disagreement for show. Each narrative implies very different trades and timing for defensive moves. That's the verdict. 4 experts, 4 playbooks, and now you can see exactly where they split.
If you want every clip, the data, and the receipts behind each thesis, the full breakdown is linked below.
If this saved you time, like, subscribe, and check the deep dive in the description. It's worth the watch.
Stay sharp, size risk accordingly, and we'll see you in the full compilation.